Okay, well, I think we have 1:30 and 4:30 on the clock here, so we'll go ahead and get started. I know some people will be joining as we get through the beginning of this. Real quick, just a note. Well, we certainly appreciate all of you tuning in today, and hope there is value that you'll be able to take away from this, and certainly to learn a little bit more about business coverage options, especially bank loan coverage. And just a quick note, my email there up front, robert@piu.org. I've actually copied that onto every slide of the webinar, so I would encourage you to just take a quick second now to open a new email message, put that email address in there, and then you have an easy way to jot down any questions and send those off to me at the end of this session. I would love to give some one-on-one attention to those questions and make sure everyone's in full understanding. So without further ado, let's go ahead and get started. And again, today's topic is bank loan indemnification disability insurance. A mouthful for certain, but I can assure you it is quite simple to understand. So first off, when a company is looking to do any of the following, whether it's consolidating debt, purchasing large inventory, new equipment, startup loan, increasing work capital, real estate remodel, acquiring a new company, seeking some funds for marketing or for an emergency situation, there's a lot of things that come to the table, and among those topics, a common theme is how much cash will we need. The business has a few outlets to obtain these funds. The first choice being they can self-fund. However, we'll understand that most small business owners' pockets look to be similar to this photo here, and any capital that they may have saved is best to be reserved for the use of the company. Our second option here is to seek out investors. And who better to depict a room full of investors than the sharks themselves, right? So an investor, unfortunately, will seek out a portion of the company or a royalty to make money basically off the money that they've lent the company. And a third and final option would be for that company to approach a bank. Now banks bring a lot of value with the ease of funds and the simplicity and timing of obtaining those funds, so that is a common sought-out choice. Basically, when a business approaches the bank, says all the right things, makes the right eye contact, and is sitting down with the loan officer about to shake hands, what they're envisioning in their head is a large vault with an open swinging door and a bright, bright heavenly light shining through the back of that vault, that all of their capital answers have been solved. And so basically they can now resume with that new project that they had in mind, continue to grow the business. But as we all know, with great risk comes great reward, as Thomas Jefferson once said. And so how exactly does this risk change when the reward is provided first? Well, that $500,000 loan isn't so much of a reward as it is just $500,000 in debt. Very similar to when you purchase a house. You're very proud that you've bought this large, magnificent house. However, you've just adopted a large, magnificent amount of debt as well. So with any line of debt, there are many risks that can play a factor. These are quite common across any risks. However, just to mention them, death, disability, and bankruptcy could all be the end or I should say a start to a long list of problems. And if any of those were to occur, the overhanging debt would be absolutely devastating. So death and disability are primarily where we are able to focus in the insurance industry. And the facts here are the chances of someone dying during their career are 1 in 10, while the chances of being disabled during that same period of time are actually 4 in 10. To expand a little bit on that risk, the importance of disability protection can really be displayed in so many ways. For instance, 90% of disabilities are caused by illness as opposed to accidents. This goes against those that say, you know, I live a very low-key life. I do not expose myself to hazardous situations. Well, there's only so many things you can do to prevent yourself from a serious disabling illness. Additionally, over 1 in 4 20-year-olds will be disabled by the time they retire. The average length of disability is approximately 2.5 years. Again, some less and some greater. And the last statistic here, 12% of America is disabled. This might not seem like a large percentage. However, when you can imagine that that entire pie represents 310 million people, that 12% is now 37 million individuals. So obviously with a risk this great, it is no doubt that banks require disability insurance on the loans that they provide. There is a common issue with the requirement of disability insurance by banks. We'll get to some of that in a little bit. So let's begin to talk about the risks that are on the shoulders of a business owner. So unlike your regular individual who has the personal finances to worry about, and this is again primarily where we focus and to make sure that they have their income covered against any of these occurrences. Those personal items being, you know, mortgage, car payment, continuing to add or not having to draw from their retirement or college savings account, insurance premiums, utilities, groceries, as well as the personal or kids' extracurricular activities. So a host of bills, both big and small. And like I said, we are very familiar with this side of personal coverage for every individual we're working with. But a business owner represents a very special risk in that they also host the risk of the business within that same body. Some of those business risks being salaries, loans, leases, utilities, insurance premiums, all the way down to office supplies, which we all know add up over an extended period of time. So again, this one individual that has to remain alive and healthy for an extended period of time in order to cover both personal and business risks, that's asking a lot of that person. For this reason, on top of personal benefits, this is why the business disability protection solutions have been provided. Many of those we're familiar with. That would be key person coverage, business overhead, buy-sell, loan indemnification, as well as severance protection. Obviously, today we'll be discussing the loan indemnification, and to go into further detail, we'll go ahead and just start by almost trying to translate it into the easiest way. It basically insures a loan against an illness or accident of that individual. How exactly does it do that? It's designed to precisely mirror the loan contract that's been put in place. This is both with the payments, whether monthly, annually, at whatever given interest rate, as well as the length of the loan. So how long that loan is going to pay out, what's the contract of the entire loan against that risk. Our common business loans range from anywhere from 1 to 10 years in amounts of $25,000 upwards of $12 million, and then some greater. But again, the most common business loans you'll find to be within that area. So going back to our picture of the vault, I like to kind of coordinate how, let's go back to the loan indemnification real quick. I like to signal how having this loan indemnification product is very similar to the vault that the business owner first pulled out of, right? So by purchasing a loan indemnification plan against their business debts, they are installing a vault underneath their desk that says, in the event you are disabled or you cannot come to work because you're sick or hurt, this vault will be there for you to pull out funds from at any time to pay that entire fulfillment of that loan. So that's a big safety overhead. And again, if they are intrigued enough as to obtain a loan from a bank, they should be intrigued enough to install a secondary vault to back that loan up if they were to be disabled. Common business loans look as follows. As you'll see here, there's a host of loans here. I won't go into detail about all of them. However, let's just look at the $60,000 loan, for instance. What we've kind of displayed here, just to give you some background, is again, that full bar is the entire amount of the loan. A lot of individuals or even insurance professionals assume that a business overhead plan or a key person policy has been put in place and that will pay the benefits of the loan. But what's not normally considered is that those benefit periods are only generally up to the maximum of 24 months. Most commonly, you'll see those at 12 months. This poses a huge risk because after those 2 years, we have a large sum of debt that's still overhanging. And where the company is after that 2-year period cannot be assumed or guessed, or it certainly wouldn't be in a better position than before the business owner was disabled. So again, $60,000 loan, let's just look at a first example here. If you were to have that covered under your BOE plan for 2 years, that would handle 50% of the loan. The business owner is still stuck with $30,000 of overhanging debt. More towards the right, maybe a $500,000 loan was needed. That would be paid back at about $5,500 a month, including interest. So after that 2-year period, that's only fulfilling 26% of the entire loan, leaving almost $400,000 at risk and overhanging of the business owner. Briefly, I've switched also to show a 12-month benefit period on those policies, which, like I said, is more common. And you'll see that the percentages and the overhanging debt are that much more increased. And, you know, again, this is just to show that a key person or a BOE policy is not enough if there's an open loan on the company for anything that they've done in the past or anything that they are considering to purchase in the future. What are some common outs that a business owner would say if you approached them and said, you know what, I understand you have this $200,000 loan. Do you have disability coverage against this loan specifically? Because if not, this could be hanging over your head at the time you're disabled when you would least like to deal with it. One of the first is they say, well, I can just sell off my purchase. I have no problem liquidating the pieces that I've gathered, and I'm sure that'll pay back a majority of the funds, and there's no need to pay an extra fee for a policy to go against this loan. As you can see by the chart that's provided here, fully recoverable assets are zero. So there's very, very few things in this world that we can get back the same value that we put into it. Do those situations happen? Sure. But again, a 99% chance that that item will not be fully recoverable against the loan. Partial recovery may be available. Maybe you bought equipment, acquired a new business, have some working capital left over from that loan, or can liquidate some inventory fast. Again, these are not things to rely on when a business owner is facing disablement, is in need for money, does not have extra time to sit around and wait for something to sell. So just because it can be partially recovered is no way an insurance that they can get themselves out of that debt should the situation arise. Completely not recoverable would be, a consolidation of debt, remodel of the estate, or if those funds went to marketing, cash in the wind as we like to refer to it, or an emergency situation. Certainly hope that's handled, but now they face an even greater epidemic. So a secondary reasoning against this, objection I should say, would be my personal DI benefits can pay for that policy. That's no problem. I have $5,000 a month of individual DI coming in. Mr. Loan Officer, that'll easily cover this payment. I'll just assign those benefits to you. Well, unfortunately, that would not be the right path to take, because the reason those benefits are in place are to pay for the mortgage, car, the list we went through earlier, and essentially by signing over those benefits to the loan policy, the bank is going to make sure that they get those funds before you use them for a personal support. So you can pretty much say goodbye to that house, that car, those savings funds, and anything else associated with your personal life. Finally, approaching what Peterson can do to indemnify a bank loan. Peterson's bank loan indemnification policy is really has the freedom to match any and every loan contract out there, with limits up to $100 million. Now that's just an astronomical amount and should surely be able to cover almost every loan out there today. But with limits up to $100 million, you know that you can say yes if a small business owner says, I have a loan for $50 million. You're thinking, holy smokes, well, I didn't know it was that great. Let me see what I can do. You can come to Peterson and they are able to assist. Benefit periods ranging anywhere from that 1 to 10-year mark. If that's not enough, we do have additional lump sums available. So say after 5 years, we've paid $1 million towards a loan and there's still an outstanding $4 million. That $4 million can be constructed into a lump sum at the end of those 5 years. It is a 5-year term product, so it's renewable throughout the contract of that loan, and also hosts riders such as a residual rider, which we're very familiar with, but also what we call the Prime Flex Loan Adjustment Rider, and this is something very neat. What this rider is able to do is for individuals who have taken out a variable interest rate policy, by adding this rider to their bank loan disability insurance, they can rest assured that this policy will pay for up to 120% of their loan payments should the interest rate fluctuate and obviously go higher. Now, 120% of that payment allows quite a bit of wiggle room for the interest rate. What we've estimated is anywhere from a 4% to 8% increase in the interest rate alone can be accommodated within that 120%. So again, a very valuable rider there. It protects a variable interest rate loan under any circumstance. And a few additional details that would be interesting about our Peterson policy. We can actually be first dollar when it comes to business coverage. because there are so few carriers participating in this realm and providing solutions, we are able to come in and take that very first dollar risk, where many of you, I'm sure, are used to hearing that we can only help in the excess realm. Surely that is an option. We can supplement on top of a traditional bank loan product and provide, those additional thousands or millions of dollars that's upfront on the table. Health risks, upper ages, I should say, our bank loan product specifically can insure individuals under the age of 75, which is very impressive and again, not seen by many. If there's an occupational risk, a loan risk, or if there's a quick issuance of the policy that's needed. Rarely does disability insurance come up while that business owner is sitting down with the loan officer about to sign the contract. So for that reason, we understand that a lot of policies need to be provided on a very quick basis in order for the loan transaction to continue to take place. Peterson International does a fantastic job of what I'd like to call a white glove service to get that underwriting done, get that policy issued and out to the client so they can know coverage is bound and is ready to be in place. And with all of the solutions kind of being aimed towards the disability side, because that certainly is our specialty and where a majority of the risk is, we should not fail to mention, what about the risk of death? For that, Peterson International offers what we call a business loan failure to survive product. What this does, it can be provided on an excess life coverage basis. So on top of a current loan life indemnification plan, or maybe your client was not medically able to qualify for that traditional life coverage. Again, this failure to survive product comes in the high ages, or if just a short term of coverage is needed in order for the traditionals to reconsider, that can all be provided by this business loan failure to survive. So with that said, that wraps up today's webinar. I thank you very much for attending and listening today. I hope you had some questions along the way, and like I said, go ahead and plug in my email to that message and send it off. I'd love to give the one-on-one expertise there and help with any questions you might have. Feel free to call our office as well. I believe we're still open for another couple hours here, so we will all be sitting at our desks patiently waiting for your call. And again, thank you very much for attending, and we hope this webinar was able to provide some information you didn't know before. Everyone have a great day, and thank you again.